Maybe before talking about CPF, let's look at what Malaysia's EPF offers. Besides a different interest rate, they apparently also provide a little bit more withdrawal options at 55 and 60. Now, the withdrawal restrictions on CPF Life has been a major point of contention, and that's always a very sticky thing because when you contribute monies in for the long term, you hope to see it coming back, right? Some families have surplus savings and don't really need it, but some families are really dependent on getting that amounts out. So in today's video, let's answer a few key questions. How do you maximize your CPF? I've collated a lot of very good feedback to illustrate what you really need to know in this video. Hi guys, welcome back. Let's start with the first comment from Kevin. CPF policy changes are adapting to the ever-changing landscape. Previously, they allowed huge withdrawals at 55, and it turned out that a large number of people cannot think for themselves. So the policy had to evolve. Some who are financially illiterate, when they get their CPF, it becomes like striking Toto like that. A windfall, and their head goes giddy. They go spending it in bars and do funny things and get all of it blown away in 1 or 2 years' time. So when they become broke, what happens? It becomes a societal problem, correct? So that's why there are restrictions. And that leads to the top comment above, which is probably many fail to understand that CPF is a national retirement savings program, and instead of fighting against it, let's try to understand it and maximize the best use of it. I think it's very well said, and that's the backbone of how we're going to do our discussion today. Because it's your own money, you should try to maximize it. And how to maximize it? Maybe this comment has a suggestion. I treat the ERS as my fixed income allocation, like a zero coupon until 65, then it pays out monthly. Zero coupon because CPF Life pays from 65 onwards only. And with a stable monthly income of 3,000 after 65. I'll seek out higher risk investments knowing I have a minimum monthly. I actually love that idea because in my private clients, I see some who are overly conservative. I coach on getting them invested to diversify their asset base and grow some above the rate of inflation. And how can we see CPF as a foundation layer to what we need in retirement? Maybe let me pull up what I do for private clients. Over here, you would see I've layered different income streams for someone at the age of 55. Dividend income and CPF OA interest theoretically can be used already from the age of 55, correct? Explaining for CPF OA interest, once you're past the age of 55 and a full retirement sum, that amounts are fully withdrawable. If you withdraw interest only, you would realize that the amount should be perpetual. Then we see also blue bars over there representing CPF Life payouts. That will kick in only at the age of 65. And if it's maximized, the amounts projected will be around $4,000 per month. Again, it's projected. Later as we go into deeper numbers, keep that in mind. Then in this case, there's also a desire to get some income streams from the age of 60 onwards. There is a surplus of savings also, and that's why there is a layering of an annuity plan there from the age of 60. Later, I'll be touching on this topic on annuity plan versus CPF Life. So stay tuned right to the very end. And in addition, if you'd like to learn a little bit more about CPF and retirement planning, look for my upcoming Finance Summit on 29th March at SMU. This will be a fully educational event, and I'll be sharing with you deeper insights on what you should really know about CPF before you make any top-ups. Topping up to enhanced retirement sum has its pros and cons. It may suit some and it may not suit the others. So if you'd like to be a little bit more savvy, join us at the summit and look for links below. Our last 3 events have been fully sold out and tickets are filling really fast right now. But what if you're facing a different situation such as this? I have a question. When I reach 65, I do not have enough for ERS. But I do have more than enough in FRS. Do I need to choose either ERS or FRS for CPF Life, or I can go with what I have in RA? Say I have 350,000, can I join CPF Life with 350,000, or I must choose FRS and ERS, which means I need to either top up or withdraw? I'm not sure, that's why I'm asking. Quite clearly, there's some parts not fully understood yet. I briefly replied, CPF Life ERS is a max limit. Unfortunately, that didn't answer the question fully because he was asking whether he needs to decide between FRS or ERS, and his amounts may fall somewhere in between. So maybe let me touch on this point to clarify things. When you reach the age of 55, only your full retirement sum will be drawn to RA. This year, it's 213,000. He mentioned over there 220,000. That sounds like next year's limit. So once full retirement sum is drawn into RA at age of 55, you cannot touch it already. All of it will be sucked into CPF Life. Clear about it? There's nothing that you need to opt or unopt. Then comes the voluntary top-up portion. And for this top-up, there are just a few parameters, which is the first, enhanced retirement sum as the max limit. You can pump in any amount until that limit, which means you can pump in $100 or you can pump in 100,000. No problem. Once it moves into RA, it will automatically be fed into CPF Life and they'll calculate your amount. Then as to when you need to top up, there's also a window. You can top up anytime after the age of 55, which means at 55, you're undecided, never mind. You can sit and wait on it. Then when you're 56, you decide, hey, I want to throw in some money to RA account. I understand it's a one-way ticket, but I'm fine with it because it compounds at 4%. Then sure, you can just lock in to transfer from OA to RA, or you can pump in cash. So again, there are two methods. This window will open all the way, and if I'm not wrong, even after you've redrawn monies out already, you can still pump monies in. That is why I understand conversing with your CPF officer. If you're a retiree, do help me validate on it because I'm not a retiree myself. I'm purely sharing with you what I understand on this system. Then there's also some confusion. This enhanced retirement sum limit increases every year, correct? Can I top up every year with it? The answer is actually yes. 426k is the limit for this year. Next year when it bumps up, you can throw in more cash into it. You realize through compounding, different people have different end amounts when they reach 65. And it doesn't matter. The projected payout will be based on what you end up from the age of 65 when CPF Life starts. What you only need to decide is which plan type. Do you want basic plan, or do you want standard plan, or escalating plan? 3 plans for you to choose, of which if you don't make a decision, the default is standard plan. So hopefully I've clarified all the questions on topping up, and as always, if you have further questions, leave them in the comments sections. Now let's go back to some other ideas on maximizing CPF. Hi Josh, good explanation. This RA scheme is getting very tricky. The 4% interest actually is a bet on one's lifespan. What is the break even then? My answer to that is let's not focus too much on break even because we don't know when we will die, correct? Later I'll show you actual numbers. If you die later with CPF Life, you get a lot more payout. But again, if we die tomorrow, then the best is to use everything tonight. No ROI will be good enough, correct? So the real question is getting guaranteed lifelong cash flow. I'm using the word guaranteed even though it's projected and a range. But what I'm trying to mean is that there is no investment volatility. So once that's clear, we circle back to the question on is it a bet on one's lifespan? We should actually rephrase this. It's actually an insurance against living too long. That is the beauty of annuity plan. And we see the 3 plans that is offered, escalating, standard and basic. You would see that for basic plan, it will drop off, correct, at some later years. That's the design of it, which means also, if you live super long, you'll be in trouble. In 30 years time, a kopi-o in coffee shop will easily be $5 already, and yet you face a drop-off in CPF payouts. I will elaborate this more on strategies in my summit, so again look for links below, and let's answer this question of how we can insure against longevity. Let me start with this question. Do you want extra layers of guaranteed income? Keyword again is guarantee. For myself, I'm okay with dividend income. Up and down, I really don't mind. But different strokes for different folks. If you want guaranteed income, fuss-free from government, then annuity plans and CPF Life are fantastic solutions. By the way, even rental income is not guaranteed now. You would see that there are periods where tenants are gone. So the real guaranteed income sources are really CPF Life and annuity plans. Let's follow this flowchart I've designed for you. And it leads to the next question. Do you want more flexibility in your money? Which means also you can customize payout like what I showed you previously in that retirement ladder. I want a payout from 60 onwards. CPF Life cannot provide me that. That's why annuity plan is used for it. Or do you want the option whereby you can surrender it out anytime? Of course, it depends on when you surrender before you can get back your principal. So if you want these flexibility options in, then an annuity plan could be a great solution for you. As long as it beats 2.5%, you are better off using your CPF OA into an annuity plan. So with that clarified, we move to the right hand side of the table, which is if you don't need more flexibility and you're concerned about living long. That's the pink box over there, live long. I use pink to symbolize pink of health, which leads to two questions. First, you're worried you may not live very long. Then naturally, you gravitate back to you want more flexibility, correct? But my question to that is, what if you really live very long? My own father is a stroke patient, and he's bedbound for almost 20 years already. We really never know when we are going, so don't assume too quickly that we will certainly die before the age of 80, for example. So if the question is you're concerned about living long and you want guaranteed income, we'll flow from a pink box to the green box. The best use of CPF Life is that it's the most secure, regardless of what you think of policy changes. Singapore government is AAA credit rating. No insurer is of that stature. In any case, insurers have also cut back on bonuses before. I work in the financial services industry. I can share that with you openly. Which means also, if you want the highest return, then topping up to retirement account for more CPF Life in the purple box makes absolute sense. If you want even more guaranteed income, then the only solution left would be annuity plans. ERS is the max. You cannot jam in $1 million. To get guaranteed income, you have to next use an annuity plan to design it out for you. To that path of thought, I also like to challenge. Is it true that you really cannot take more volatility? This becomes very personal. No right, no wrong. My style again as an investor is I'm comfortable with dividend income, ups and downs. But my question here is to pose whether that is sufficient or not so that you can maximize your real return differently. If you invest properly, getting the right dividend income should be easily above what you can get and from an annuity plan. But again, it's non-guaranteed. Coming to you, if you have questions, leave them in the comment sections. Thank you very much. Smash the subscribe, especially if you haven't done so. And join us as we march towards 70,000 subscribers. A new level to look towards. So again, thank you very much. And let me put up a next question to further help us understand how to maximize CPF, which is from Terence. How does this CPF Life compare to an annuity plan by private insurer? Obviously, you trade policy risk with corporate default risk, but are payoffs more secure than CPF Life? To compare CPF Life against an annuity plan, we next need to understand how the payouts work and what is the death benefit. Let's use as an example. Male, age 55 this year, full retirement sum $213,000. When you compound this from 55 to 65, it will be roughly $315,000. This amount of $315,000 will pay you $1,700 per month from the age of 65. And as you can see, this amount is stable. This amount is constant to 95 and beyond. First quick observation you can draw is that $1,700 times 12 over 305k, that will mean around a 6.5% payout yield, correct? From this point of view, this is superior already to an annuity plan. But is this the right way to look at it or not? Maybe not so. Because if we understand how CPF Life annuity pool works, for your unused CPF Life annuity premiums when you die, CPF will pay you the premium balance, which is the total CPF Life that you've contributed minus the total payouts you received. That means again, what you have put in, less gradually what they have paid out for you already. It's not what you put in. And if you understand so, you understand it's a return of capital. No gains, no interest, and that's where usually the contention lies. Hey, where's all my interest? It's gone already. Again, this is an annuity pool structure. So there are pros and cons, which means we can calculate exactly when you start to benefit from it. The formula to use would then be $1,700 per month times 15 or 16 years to get back this $315,000. That again is your principal that you put in. If you start from the age of 65, your returns only come after the age of 80 or 81. From 65 to 80, you realize that you're still at your capital level. No capital losses, but also no benefit. No interest per se. Which is also why just now I mentioned in that table that I've drawn up for you, if the primary concern is guaranteed income and the primary risk is longevity, then CPF Life stands out. Because again, I've drawn up for you in this table below, if you pass at the age of 70, 75 or even 80 years old, net you'll get zero rate of return on your $315,000 parked inside. I've used a calculator to estimate what is the internal rate of return if you die at the age of 85. For the CPF Life Standard Plan, it will be around 2.7%. Because again, you're getting 1,700 per month in addition to your capital already. Understand it? This figure goes up and up the longer you live. You get it? At the age of 90, it's around a 4.2% internal rate of return. At the age of 100, it's around 5.5%. At the age of 110, it's 6%. Then assuming future there's some science that allows us to live 200 years old, it'll not exponentially go up, but it'll just plateau around the rate of 6.4% mentioned just now. So to this point, it makes it very clear. We are going to see more people living to 100 years old in Singapore. CPF Life is very likely the most secure and highest return if you live to the age of 100 years old. 5.5% guaranteed is unbeatable. The trade-off is especially if you die younger. Again, there are pros and cons, and I'll continue to share them with you in this channel, but we've discussed a lot today already. I think I'll cut the video short right here to let you ponder on some things, and I'll keep them for a future episode. Thank you for watching at the very end. See you at my CPF Retirement Summit, and with that, I'll sign off from here. Take care and goodbye.